Most retail traders spend their careers searching for the perfect indicator. Institutions spend their careers understanding capital flows. The difference is enormous. When I evaluate a Forex opportunity, I am not asking whether Euro USD looks bullish or bearish. I am asking where global capital is likely to migrate over the next several weeks and whether that migration creates a favorable risk-adjusted return profile. Currencies are not lines on a chart. They are representations of entire economies competing for capital. Every swing trade begins with macroeconomic analysis. I want to know which central bank is tightening, which economy is accelerating, where bond yields are expanding, and where institutional money is seeking safety, growth, or yield. The foreign exchange market is ultimately a capital allocation mechanism. Money moves. Our job is to identify where it is moving before the majority notices. I monitor sovereign bond markets, interest rate differentials, inflation expectations, commodity flows, and risk sentiment because currencies rarely move independently. When U.S. Treasury yields strengthen, I expect implications for the dollar. When crude oil rallies, I evaluate its effect on commodity-linked currencies. When global risk appetite expands, I analyze how capital may rotate into growth-sensitive currencies. The chart is simply the final footprint of a much larger process. Price is evidence, capital flow is the cause. As a swing trader, my objective is not activity, my objective is efficiency. I would rather wait 2 weeks for a world-class opportunity than force 10 mediocre trades. Patience is a competitive advantage because most market participants cannot exercise it. My process begins on the weekly chart. The weekly chart reveals where institutions have been accumulating positions for months, sometimes quarters. The daily chart refines that narratives. The 4-hour chart provides execution. By the time I enter a position, multiple time frames, macroeconomic conditions, and intermarket relationships have already aligned. The trade itself becomes the easiest part of the process. Risk management remains the foundation of everything. Many traders believe wealth is created through aggressive leverage. Professional traders understand that wealth is preserved through intelligent exposure. I am not interested in maximizing returns on a single trade. I am interested in maximizing compounded returns over decades. A hedge fund manager thinks differently. Every position must justify the capital allocated to it. Every risk must be measured. Every reward must be evaluated relative to uncertainty. The question is never how much can I make. The question is how much am I risking to pursue this opportunity. That distinction separates professionals from speculators. I seek asymmetric opportunities where potential reward substantially exceeds defined risk. When favorable expectancy combines with disciplined execution, the mathematics become extraordinary. Compounding begins to operate. Capital begins to attract more capital. The portfolio becomes an asset-producing machine. Over time, the objective is not merely to win trades. The objective is to build a repeatable decision-making framework capable of producing superior risk-adjusted returns regardless of market conditions. That is how institutions think. That is how professional money is managed. And that is why the wealthiest traders in the world are rarely obsessed with predictions. They are obsessed with probabilities, process, capital preservation, and strategic capital deployment. Because fortunes are not built by being right once. Fortunes are built by allocating capital intelligently thousands of times.